Warren Buffett is one of the richest people on the planet, with a net worth of over $100 billion. But what's even more impressive is how he got there. Unlike most investors, Buffett didn't get rich by taking big risks or chasing the latest trends. He followed a simple set of rules that helped him build wealth over decades. In fact, Buffett's rules are so effective that they've turned him into one of the greatest investors in history. Here's a shocking fact: over 90% of Warren Buffett's wealth was earned after the age of 65. Yes, he didn't even hit his peak until later in life, proving that long-term thinking and patience can pay off big. And here's another interesting stat: Buffett has managed to grow his company, Berkshire Hathaway, at an average rate of 20% per year since 1965. That's nearly double the average return of the stock market. In this video, we'll break down the 7 key rules Warren Buffett lives by. These rules aren't about chasing the latest trends or getting lucky with a hot stock pick. Instead, they focus on timeless principles that anyone can follow to make smarter investment choices. Whether you're just starting out or looking to refine your strategy, these rules can help you think like a billionaire. Want to learn how Buffett made millions by staying calm when others panicked? Or how he picked companies that made money year after year? Stick around, because in the next chapters, we'll uncover the strategies that helped Buffett become the Oracle of Omaha. Chapter 1. The Invisible Edge. Buffett's moat strategy. When it comes to investing, Warren Buffett has always believed that one key factor separates successful companies from those that might struggle: the economic moat. A moat, just like a castle's protective barrier, keeps competitors away, ensuring the business can maintain its profitability for years. Think of companies like Coca-Cola or Apple. Both have strong moats. Coca-Cola's global brand recognition and customer loyalty make it almost impossible for competitors to take away market share. Apple, with its sleek design and ecosystem of products, holds a unique position in the tech world. Buffett often emphasizes that businesses with wide moats can withstand economic downturns better than others. This makes them more predictable, less risky, and more likely to generate steady profits over time. When he looks at a company, he's not just thinking about today, but whether that business can stay on top in the long run. He famously said, "The business that makes the most money is the one that has the widest moat." A fun fact: in 1999, Buffett made a bet with a hedge fund manager about who could generate better returns over the next decade. Buffett chose a simple low-cost S&P 500 index fund, and the hedge fund picked a basket of hand-picked stocks. By 2009, Buffett had won the bet by a wide margin, proving that sticking to companies with solid fundamentals and moats can lead to steady, long-term growth. Moats can come in various forms: strong brand, economies of scale, patents, or high switching costs for customers. If a business can create a product that customers don't easily replace, it's more likely to maintain high margins and return on investments. Just like Buffett, take time to analyze the moat of any business before investing. This strategy is about finding companies that are durable and resistant to competition. Chapter 2. Patience is your secret weapon. Buffett's waiting game. Buffett is often called the Oracle of Omaha, but what most people don't know is that his success is largely built on patience. While others are trying to chase quick returns, Buffett focuses on the long haul. His approach is to buy high-quality companies and wait for them to grow. In fact, he has said, "The stock market is a device for transferring money from the impatient to the patient." This strategy isn't about making a quick profit. It's about waiting for the right opportunity. Buffett has famously held onto stocks for decades. For example, he bought his first shares of Coca-Cola in 1988, and he didn't sell a single share for over 30 years. In that time, Coca-Cola became one of the most profitable investments in Buffett's portfolio. Research shows that most active traders fail to outperform the market in the long run. A study by the National Bureau of Economic Research found that 96% of active fund managers underperformed the market over a 15-year period. The moral here? If you can practice patience and hold on to great companies, the market will reward you over time. Buffett's long-term focus also keeps his portfolio stress-free. He isn't swayed by short-term market fluctuations. He understands that the stock market often reacts emotionally, and that can create buying opportunities when prices are low. This patience can turn a good investment into a great one. Remember, it's not about timing the market, it's about time in the market. Chapter 3. The Two-Page Rule. Simplifying investment decisions. Buffett's famous two-page rule is a strategy that many investors overlook. He insists that he only invests in businesses he can easily understand. The idea is to keep things simple. Buffett says, if you can't explain it to a 10-year-old, you don't understand it yourself. This approach directly contrasts with many investors who are always searching for the next complex stock pick or obscure opportunity. Buffett, however, prefers to avoid complications. He likes businesses that operate in industries that make sense to him. That's why he steers clear of tech stocks for the most part. He simply doesn't understand them as well as other industries. While tech can be lucrative, it can also be unpredictable and complex. To put this into perspective, Buffett has often stuck with businesses like Dairy Queen, See's Candies, and Geico, companies that have predictable earnings and clear business models. When Buffett first bought See's Candies, he wasn't dazzled by high-tech innovation. Instead, he saw a company with a simple business model and a passionate customer base. And over time, that investment grew into a cash-generating powerhouse. Buffett's two-page rule is a lesson in clarity. If a business can't be explained simply, it's probably too risky. In fact, according to research from Fidelity, the more complex an investment is, the harder it is to accurately predict its future performance. Complexity is often a sign of hidden risks. So, as an investor, simplify your decision-making process. Stick to businesses you understand, and don't overcomplicate things. When you focus on what you know, you'll have a better chance of making solid investment choices, just like Buffett. If you're enjoying these strategies, make sure to hit the subscribe button to get more valuable tips straight from the investment master himself. Chapter 4. Risk. Buffett's unseen strategy to dodge disaster. When it comes to investing, most people think of risk as losing money in the short term. But for Warren Buffett, risk is all about the likelihood of permanent loss. In other words, he's more concerned with making sure an investment is safe in the long run, rather than worrying about market swings. As he famously said, risk comes from not knowing what you're doing. This is why he avoids anything that's too complex or difficult to understand. The simpler and more predictable, the less risk. One of the best examples of Buffett's approach to risk is his decision to avoid technology stocks for much of his career. In the 1990s, when the tech boom was in full swing, Buffett stayed away from companies like Amazon and Google, because he didn't understand their business models. While this might seem like a missed opportunity, Buffett's strategy paid off. He focused on businesses with predictable earnings, like Coca-Cola and American Express, which were easier to assess for long-term safety. Buffett also doesn't invest in businesses that rely on the whims of the market or consumer trends. For instance, he stayed away from businesses in the fashion industry, which often face unpredictable changes in consumer taste. Instead, he focused on timeless products, ones that people would keep buying no matter what the economy was doing. By doing so, he reduced his risk significantly. A great example of his cautious approach is his investment in Geico. Buffett saw the risk of the company failing due to competition from larger insurance companies. But instead of avoiding it, he understood the long-term potential of Geico's low-cost model. His deep analysis and understanding of the risks allowed him to make an informed decision that paid off in a big way. Buffett's risk-averse strategy teaches us that if you understand the business, you can reduce the chance of permanent loss. In other words, smart investors focus more on reducing risk than trying to make quick gains. Chapter 5. Buy and hold. But with a twist. Buffett's Coke versus tech debate. Warren Buffett is often known for his buy and hold strategy. He believes in holding on to solid businesses for the long term, rather than constantly buying and selling. The key to this approach is to choose companies that you believe in and that you trust to grow steadily over time. But there's a twist. As the world changes, Buffett's strategy has evolved. For decades, Buffett stuck to what he knew, old-school businesses like Coca-Cola and See's Candies. He famously said, "Our favorite holding period is forever." His logic was simple. If you find a great company, why sell it? But that doesn't mean he never changes his mind. As technology has become more important in our world, Buffett has gradually warmed up to tech companies. One of the biggest shifts in Buffett's thinking came with his purchase of Apple stock. Despite avoiding tech for years, he recognized that Apple was more than just a tech company. It was a brand with a loyal customer base, a strong moat, and a solid cash flow. Apple's ability to make consistent profits from its ecosystem of products, like the iPhone, made it a safer bet than other tech companies. As Buffett once said, "The world's best business is one that can be run by someone who can't see." Buffett's investment in Apple shows that even the best investors can adapt to changing markets. However, he still sticks to the idea of buying businesses that he truly understands. For example, while Buffett has invested in tech, he's stayed clear of the fast-paced world of biotech or speculative startups. His approach remains grounded in buying businesses with strong fundamentals and clear, predictable futures. The twist in Buffett's strategy is recognizing that innovation matters, but only when it fits within his principles of understanding the business and its ability to generate long-term profits. For investors, this means finding companies that have staying power, even if they operate in industries that once seemed out of reach. Chapter 6. The Contrarian Playbook. How Buffett Sees Fear as Opportunity. Warren Buffett has made some of his best investments when the market was in panic mode. While most investors run for cover during market downturns, Buffett sees opportunity. He famously said, "Be fearful when others are greedy and greedy when others are fearful." This strategy has made him billions. When everyone else is selling, Buffett is often buying. A great example of this comes from the 2008 financial crisis. While banks were collapsing and the stock market was in freefall, Buffett made bold moves. He invested $5 billion into Goldman Sachs, a decision that paid off handsomely as the market recovered. At the time, many investors were selling their stocks in a panic, but Buffett's ability to see value in a distressed market allowed him to buy shares at a steep discount. But it's not just about buying stocks when the market is low. Buffett also looks for companies that are undervalued due to temporary problems. He has a knack for finding situations where fear is driving prices down, even though the company's long-term fundamentals are strong. For example, his investment in American Express during the 1960s was based on this kind of thinking. The company was struggling with a scandal, but Buffett saw past the short-term issues and recognized the company's long-term potential. Buffett's contrarian playbook isn't about going against the market for the sake of it. It's about finding opportunities where others see risk. In fact, research has shown that buying during times of fear often leads to higher returns in the long run. A study by Yale University found that the market tends to rebound strongly after major crises, which is why Buffett's strategy has proven so successful over time. For everyday investors, the lesson is clear: don't let fear control your decisions. When others panic and prices fall, take the time to analyze whether the market is overreacting. If you can buy companies that are temporarily undervalued, you might be setting yourself up for a big payoff. Don't forget to subscribe for more insights into the strategies that have made Warren Buffett a household name in the investing world.